I have lived long enough to know that most people only notice an oil shock when they see the number at the gas station. By then, the damage is already moving through the system. Oil is never just oil. It is freight, it is fertilizer, it is diesel, it is airline tickets, it is plastics, it is packaging, it is groceries. It is the hidden meter running behind almost every ordinary life. And when that meter jumps fast, the middle class does not get hit in one place. It gets hit everywhere at once. That is the part people forget. They look at a barrel price and ask whether it is temporary. I look at family cash flow and ask a much harder question. How many parts of an ordinary household budget can take another shock before the entire machine starts coughing? That is the question that matters. I have seen versions of this movie before. The details change, the television graphics change, the politicians change, the explanations change, but the sequence is old. Energy jumps, necessities get more expensive, confidence breaks, spending slows, employers get cautious, asset prices reprice. Then the same people who thought they had a little cushion realize they were standing on a trap door. That is why the last time oil did this, it did not merely hurt the economy. It carved through the middle class. And if you think the danger now is only about filling up your tank, you are looking at the first domino and ignoring the table. Let me tell you how this really works. The first mechanism is what I call the commuter tax. It is the most obvious one, which is exactly why people underestimate it. When gas jumps by $1 in a short span, most households do not say, "That is unfortunate but manageable." They start making silent cuts, fewer dinners out, delayed repairs, one less weekend trip, one less subscription they actually enjoyed, one more month before replacing old tires, one more month before buying a laptop, one more month before moving, one more month before breathing. That is how the middle class gets hurt. Not with one dramatic blow, with 1,000 little hesitations. A household that spends an extra $100 or $200 a month on fuel and transport does not experience it as a market event. It experiences it as life getting tighter, and when millions of households get tighter at the same time, the economy feels it long before economists finish debating the label. People love abstractions. I prefer arithmetic. If your income rose 20% over a few years, but your mortgage costs doubled, your insurance rose, your groceries rose, and now your fuel bill spikes again, you are not richer. You are simply being outpaced more politely. That is what an oil shock does. It exposes fake progress. The second mechanism is the freight ladder. Most people think expensive oil means expensive driving. That is the kindergarten version. The adult version is this. Everything has to move. Food moves, parts move, appliances move, medical supplies move, building materials move, online orders move, raw inputs move, before finished goods move. Every truck, ship, warehouse, and delivery chain feels the same pressure, and every link passes some of that pain to the next link. By the time a family sees a higher grocery receipt, that price has already climbed a ladder farm, processing, packaging, trucking, storage, retail. None of those steps are free. Now add fertilizer. Add petrochemicals. Add the cost of keeping shelves stocked. Add the fact that many businesses do not have room to absorb the hit because margins were already thin. The final number the customer pays is not just higher fuel. It is higher fuel multiplied through an entire chain. That is why an oil shock behaves like a tax. Nobody votes on it, nobody approves it, nobody escapes it, but everyone pays. And the middle class pays the highest emotional price because it still tries to keep normal life looking normal while the math is getting uglier underneath. The third mechanism is the confidence trap. This one is more dangerous because it is invisible until it is everywhere. Consumer spending is not driven only by money in the bank. It is driven by how safe people feel about the next 6 months. A man with money will still postpone a car if he thinks his industry is weakening. A family with decent savings will still delay moving. If they feel layoffs spreading, a young couple can still talk themselves out of having a child or buying a house if the future suddenly feels narrow. Oil shocks make the future feel narrow. They do it fast, and they do it at the exact moment many households are already fatigued. That is the important context. This is not happening in a relaxed economy with wide cushions and cheap capital. It is happening after a period of expensive borrowing, expensive housing, expensive insurance, and a labor market already being shaken by automation. That means the confidence hit is not arriving on fresh pavement. It is arriving on cracked ice. I want you to notice how nasty that combination is. Higher living costs make people spend less. Fear about jobs makes people spend less. When both happen together, businesses do not see resilience. They see weaker demand, and when businesses see weaker demand, they do not become generous. They become defensive. That takes us to the fourth mechanism, the payroll squeeze. This is where the middle class stops merely paying more and starts earning less securely. A business facing softer demand and higher operating costs has only a few levers. It can raise prices, it can cut hiring, it can reduce hours, it can cancel projects, it can delay expansion, it can lay off people, it can squeeze vendors, it can pretend for one quarter and then do all of it anyway. Now add artificial intelligence to the scene. This is what makes the current cycle more dangerous than the simple history lesson. Most people are telling themselves in prior oil shocks, companies still needed most of the same bodies to keep the machine running. Today, many management teams are already asking a different question. Which jobs can we remove permanently? That changes the psychology. Higher oil slows spending. Slower spending pressures margins. AI gives executives permission to cut deeper and call it efficiency. Do you see the setup? Oil shock by itself is bad. AI-driven labor rationalization by itself is bad for certain workers. Together, they create a beautiful excuse for every weak manager in America to cut payroll and call it strategy. That is why I do not laugh when people say the job market feels strange. Strange is what it feels like when several pressures that used to arrive one at a time now arrive on the same morning. The middle class is not built to absorb synchronized shocks forever. It can survive one problem. It struggles when transport, food, housing, insurance, credit, and job security all get worse in the same season. That is when ordinary people start financing normal life with denial. The fifth mechanism is the rate lock. This one confuses many people because they assume a slowing economy automatically means easier money. Sometimes it does. Sometimes oil prevents it. If energy prices stay high, inflation stays sticky. If inflation stays sticky, the central bank gets less freedom to cut rates. If rates stay high, mortgages stay painful, business borrowing stays painful, refinancing stays painful, and every interest-sensitive corner of the economy keeps dragging its feet. This matters because the middle class does not just buy things, it finances things. Cars are financed, homes are financed, small businesses are financed, education is financed. A big part of modern middle-class life is not owned outright. It is rented from the future. So when rates stay high because oil keeps inflation alive, what gets squeezed is not just desire, it is access. People can want a house and still not qualify. They can want a car and still not justify the payment. They can want to start a business and still back away because debt service looks like a hanging rope. That is what I mean when I say an oil shock can wipe out the middle class. It does not need to destroy everyone physically. It only needs to keep closing doors, one closed door at a time. The sixth mechanism is the asset mirage. This is where people fool themselves right before the pain becomes obvious. When times feel uncertain, many households tell themselves they are fine because their house is worth more, their retirement account is still decent, or they can always tap a line of credit if they need to. That is not wealth. That is confidence leaning on valuation. The moment cash flow gets weak and credit gets tight, paper comfort starts evaporating. Home equity is not groceries. A hires estimate is not job security. A retirement account is not liquid freedom if you are selling into fear or borrowing against a balance sheet while your income weakens. I learned a long time ago that middle class destruction rarely begins with obvious poverty. It begins with soft assumptions. My job will probably hold. This payment is probably manageable. Rates will probably come down. Gas will probably normalize. My house will probably protect me. That word probably has ruined a lot of families. Look back at the oil shocks people remember. In 1973, the system was hit in a way people had not prepared for. In 1979, the economy was hit again before it had healed cleanly. In 1990, energy pressure fed directly into a recessionary atmosphere. In 2008, oil spiked into a structure that was already rotten for different reasons, and the result was carnage. In 2022, the spike was severe, but it eased quickly enough that a full recession did not take hold the way many expected. That last part matters. Duration is everything. A spike is painful, a sustained squeeze is destructive, a short shock bruises budgets, a long shock rewires behavior. If the pressure fades quickly, consumers recover, businesses breathe, and policymakers regain options. If the pressure hangs around, the system starts adapting in darker ways. Hiring freezes become layoffs, delays become cancellations, caution becomes contraction, households stop thinking about opportunity and start thinking about survival. Once an economy becomes survival-minded, asset prices stop being about stories and start being about cash flows. That is when the fantasy ends. I want to say something most people need to hear. Do not wait for the government, a television anchor, or an economist to inform you that the pain is real enough to deserve your attention. By the time the consensus settles, markets have already repriced and households have already adjusted downward. You do not need a recession declaration to know what strain feels like. You can see it in restaurant traffic You can hear it in the language of managers. You can feel it in how friends talk about buying homes, changing jobs, or making large purchases. You can see it when people with decent salaries still sound tired. That is the smell of a system becoming less forgiving. Now let me tell you where investors get this wrong. They assume that because a recession is possible, the correct response is to freeze. That is amateur thinking. I never built anything by freezing, but I also never survived hard periods by being sloppy. You do not solve an oil shock by becoming dramatic. You solve it by becoming precise. That brings me to the operating system. When an energy shock collides with a fragile consumer and an AI-disrupted labor market, I use a very simple protocol. First, I protect cash flow, not fantasy, not ego, cash flow. If your household or business is overextended, now is the wrong time to admire your courage. Get lean, cut obligations that were only comfortable in a softer world. Rebuild breathing room. A person with optionality sleeps better and buys better. Second, I stop mistaking fixed costs for identity. Big cars, oversized houses, and expensive habits feel harmless when the system is generous. They become anchors when the system turns. Middle-class destruction often begins with trying to preserve a lifestyle that was financed under yesterday as assumptions. Pride is expensive. Flexibility is cheaper. Third, I treat volatility as inventory. If I believe the American economy will be larger in 10 years, then lower prices on strong assets are not a tragedy. They are inventory arriving on sale. But I only buy what I understand, and I buy it in a way that lets me survive if the sale gets deeper. That means broad, productive assets for the core. Not theatrical bets, not panic trades, not gambling disguised as conviction. Fourth, I separate hedges from engines. Gold can be a hedge. It is not my engine. Consumer staples can be defensive. They are not my whole plan. Energy can benefit from a longer shock. That does not mean I build my future on a headline. My engine remains productive ownership, businesses, broad equities, cash, generating assets, things that can outgrow temporary fear over long stretches of time. Fifth, I respect the sectors that get hit unevenly. An oil shock is not one trade. Airlines do not feel it the way pipelines do. Consumer discretionary does not feel it the way staples do. Weak balance sheets do not feel it the way strong ones do. Rate-sensitive sectors do not feel it the way cash. Rich sectors do. The lazy investor hears one macro story and buys one crude response. The disciplined investor asks which part of the system is being taxed, which part is being paid, and which part merely looks cheap because it deserves to sixth. I keep buying through the panic in measured intervals. Always be buying does not mean always be blind. It means I do not hand my future to my mood. If the market falls because the world gets scared, I do not suddenly become a philosopher. I keep my schedule. I buy quality. I add more when discounts deepen. I refuse to let fear interrupt a process designed for exactly these moments. Seventh, I invest in my earning power with the same seriousness I invest in securities. This cycle is not just about oil. That is the key. Oil is the accelerant. AI is the restructuring force. Anyone whose work can be reduced to repetitive digital motions is already in the blast zone. The middle class will not be rebuilt by nostalgia. It will be rebuilt by people who can manage systems, make judgments, sell clearly, think independently, and produce value that automation cannot cheaply flatten. In an oil shock, protecting your income matters. In an AI shift, upgrading your income matters even more. That is why I tell people the same thing in plain English: own better assets. Build a better skill stack, carry less dead weight, need less from the world, expect less mercy from the cycle. There is another mistake I want to kill right now. People say recessions and crashes create millionaires. As if that means pain is good. Pain is not good. Pain is simply useful to the prepared. That is different. A bear market does not reward intelligence alone. It rewards liquidity, discipline, emotional control, and the refusal to confuse temporary noise with permanent impairment. Many people know what they should buy when markets fall. Very few have arranged their lives so they can actually do it. That is why preparation matters more than prediction. You do not need to know exactly whether the war ends next week, oil falls to a harmless level, or the whole thing drags out longer than anyone expects. You need to know what you will do in either case. If oil falls fast, some of the pressure eases, confidence can rebound, rate expectations can soften, the economy breathes. If oil stays high, then inflation pressure lingers, consumers get pinched harder, employers get harsher, and asset prices may offer better entry points. In both worlds, panic is useless. In both worlds, clarity pays. In both worlds, a household with low leverage, steady investing, strong skills. And emotional discipline will outperform a household chasing appearances and reacting to headlines. That is the real lesson. The middle class does not get wiped out only because oil rises. It gets wiped out because it is taught to live as if fragility were normal. Too much house, too much car, too little liquidity, too little understanding. Too much dependence on one paycheck, too much faith that the next quarter will be kinder than the last one. That is not a stable design. And when oil rises into a weak design, the weakness shows. So if you want my blunt view, here it is. Do not spend this period asking whether the headlines are overreacting. Ask whether your system can absorb another year of expensive essentials, slower hiring, tighter credit, and noisier markets. If the answer is no, fix the system. If the answer is yes, sharpen the buying list. That is how grown investors behave. The television will keep searching for a cleaner story. There probably is not one. Maybe the conflict cools and oil retreats. Maybe it lingers and the damage spreads. Maybe GDP avoids the technical word recession, while millions still feel poorer. Maybe the stock market falls before the data confirms anything. Maybe it rises while the economy still feels miserable. Markets are under no obligation to make emotional sense to you, but your own behavior can still make sense. When energy shocks hit a stretched economy, the middle class suffers first because it lives closest to the margin. It spends the largest share of its life on necessities, financed obligations, and confidence-sensitive decisions. That is why these episodes feel so personal. They are personal. The price at the pump is not just a price. It is a warning shot. It is telling you the system is less forgiving than it looked. It is telling you every weak assumption is about to get tested. It is telling you the people who survive best will not be the loudest, the angriest, or the most certain. They will be the ones with discipline, the ones with cash flow, the ones with patience. The ones buying strong assets while weaker people are selling them to feel safe. I have learned to respect that pattern. When oil shocks collide with complacency, the middle class gets thinner. When oil shocks collide with discipline, ownership changes hands. That is the knife edge. Choose which side of it you want to live on. Let me go one layer deeper, because this is where serious people separate from spectators. When oil surges, you have to think in concentric circles. The inner ring is immediate pain, fuel, freight, utilities, travel. The middle ring is behavioral change, smaller carts at the grocery store, longer replacement cycles for electronics, fewer restaurant visits, postponed moves, postponed hiring, postponed risk. The outer ring is repricing, lower expectations for cyclical businesses, pressure on weak retailers, pressure on rate-sensitive assets, pressure on companies that lived on cheap capital and optimistic demand assumptions. And right there, hidden inside the pressure, is the opportunity set. I do not chase whatever television says should win next week. I ask a colder question: what survives a cost shock and comes out with more share, stronger pricing power, and less competition on the other side? Sometimes that is a boring consumer staple business with loyal demand. Sometimes that is an energy producer enjoying better economics. Sometimes that is a dividend payer with real cash generation and a balance sheet that does not need mercy from the bond market. Sometimes that is a broad index fund bought when frightened people are liquidating perfectly good businesses because they need psychological relief. This is why I tell investors to stop worshiping excitement. Excitement is expensive. Durability is cheap only when fear is loud. If I buy a broad piece of productive America at a discount, I do not need to know which pundit will be embarrassed. Next quarter, I need to know that good businesses, bought sanely, tend to survive the storms that kill the over-leveraged and the overhyped. That has been true longer than I have been alive. And if I want income, I do not kid myself either. Cash flow investing only works if the cash flow is real. A dividend is not magic. It is a claim on business earnings. So I want the kind of companies people still buy from in hard times, or the kind of assets that can tolerate a rough patch without cutting me off at the knees. I do not reach for yield. Just because a screen flashes a big number in a stress cycle, fake yield gets exposed faster than fake courage. The same discipline applies to housing. A lot of people think an oil shock only matters for stocks and jobs. Wrong. If energy stays high and rates stay stubborn, then affordability stays broken, moving activity stays slow, and any part of the housing market, depending on cheap financing, stays awkward. The middle class feels that twice. First, in its own budget. Second, in the shrinking room to upgrade, relocate, or refinance. A house can be a wonderful place to live and a terrible thing to depend on for emotional security. I never liked the habit of treating home equity like an ATM. That habit looks clever in soft conditions. It looks suicidal when cash flow tightens and valuations soften. Do not borrow against an illusion and call it a plan. That sentence alone would save a great many people a great deal of suffering. There is also a moral side to all this that nobody likes to discuss. A long oil shock changes behavior before it changes statistics. People become shorter with one another. They delay generosity, they become more tribal, they make political judgments with their wallet already hurting. That social pressure then feeds business pressure and market pressure. So when I say oil can wipe out the middle class, I do not just mean portfolio values or spending power, I mean confidence in the future. A country with a confident middle class behaves one way. A country with a cornered middle class behaves another way entirely. That is why you must not let this period make you stupid. Do not turn anxious and call it informed. Do not turn political and call it analysis. Do not turn passive and call it patience. Look at your numbers. Look at your debt. Look at your savings runway. Look at how dependent you are on one employer, one narrative, one monthly check. Then act if you need a final rule. I will give it to you in one sentence. In an oil shock, the people who keep optionality gain ownership from the people who ran out of it. That is how fortunes quietly move during hard cycles. Not with fanfare, with forced selling on one side and prepared buying on the other.